What's up YouTube? It's Ron from Ronald Rohde Law, and today in this video I'm going to point to 4 specific examples in various commercial real estate asset classes that point to a recession is coming. Okay, there's a lot of data out there, and one of my biggest pet peeves is people talk about commercial real estate industry as a whole, but the reality is that it is not a monolithic sector. There are huge disparities between an office building in San Francisco and an industrial truck parking in Dallas, Texas. Both of those have very different economics, and right now the future is very mixed about these particular assets. So smash that like button, grab a tub of popcorn, and tune in as I show you very specific examples about why commercial real estate is headed for a world of pain. If you're new to this channel, welcome. Please check out the other videos that I have. I'm a commercial real estate attorney. If you're returning, thanks for the love. And before we get started, I'm going to do a giveaway. If anybody watching is a golfer, I have these couple of golf head covers. I've got a couple more, but drop a comment down below where you're watching, and you can protect your clubs over the winter, or maybe if you're in Florida, you're just needing them as you head into the season. So let's get started. My number one concern is going to be office. Okay, everybody knows that office is in pain. All of the CMBS debt, we see trillions and trillions of CMBS debt that's coming due. A large chunk of that is office. However, nobody is surprised when office is having difficulty renewing their leases, they're having trouble refinancing or even selling their properties. Everybody who has bought office in the last couple of years understands the risk. But as we see WeWork here, the bankruptcy court approves 67 more leases that they're terminating. That's 67 landlords that are feeling a pain of loss of NOI or a reduction. Now, if you watch my other videos, I think that WeWork as a landlord, if you're a smaller landlord, it's not as much of a pain because most of these landlords are going to step into their shoes and assume the WeWorking business model. So you're cutting out the middleman, you're cutting out their profit, but a lot of these full service buildings will just manage it directly. Instead of WeWork co-working, it's going to be Ron Rohde works in the office, Ron Rohde office co-working. And so we have a variety of these leases. Several of them are in Manhattan, and you can see them reference one particular landlord here, Walter and Samuels. Okay, if they're a major unsecured creditor, they have full-time staffing, they have marketing, they have legal, accounting, they can handle this. And so if there are existing tenants and if that location is profitable, they're going to be able to continue the co-working trend. So continuing with the office pain, we have Eli Schwartz. If you follow this channel, you know that I have no love for this guy. I think he's a fraudster and scammed a lot of people, and he defaulted on another $30 million loan. This is an office property, so he's in a lot of pain right now, and it's really just a sign of a combination of maybe a bad operator plus bad financing makes him default. And so office, that definitely gets the grade of thumbs down. Office is in trouble. Now, what about retail? I've talked a little bit about retail spacing. This is shopping centers. These are your malls. These are your freestanding stores. We've seen a lot of turmoil, right? Bed Bath & Beyond filed bankruptcy, Party City, Tuesday Morning. There's a lot of these big box retailers who have struggled. On the flip side, there are a lot of retailers in the restaurant side that have done well post-COVID just because of a lack of supply. People have been spending COVID-era money, and they've been mostly spending that in restaurants. However, as the COVID money has run out, these concepts like ghost kitchens are going bankrupt. And so this Kitchen United is completely shutting down all of its brick and mortar. It has no partnerships. It has no hopes of delivering these ghost kitchens. And instead they're pivoting to software. I mean, what a huge 180, going from brick and mortar kitchens to software only. Crave Kitchens has also shut down. Cloud Kitchens shut down, and they had plans to open 700 ghost kitchens. So even though people's spending is coming down, it is drastically hurting these so-called ghost kitchens. And so I think retail is in for a little bit of a rocky time depending on who your tenant base is. But we're starting to see some cracks in restaurants. Let's talk about everybody's favorite, multifamily. So the darling of commercial real estate investing for the last 5 years, and gurus all over the internet love multifamily. Safest investment. Everybody needs a place to live. Okay, well, that's great, but what price are you paying for that unit? And everybody needs a place to live, but do they need their own apartment? Are they going to get that one bedroom, or are they going to downsize into a studio? With the incredible boom of construction on new construction, Class A multifamily, we have Salt Lake City, San Jose, we have Dallas, Charlotte. All of these markets experienced thousands, tens of thousands of new apartments being built. If you ask me, they all look the same. They all have the same swimming pool, and they've got a dog park, and they have names like Madison or Kaylee or the Ashland. They all sound the same. They all have got gray countertops. And so what's happening now is they're competing for the small pool of tenants. So we see 30% and we see 6 weeks free. We're up to 8 weeks free in certain markets. And this is really going to put downward pressure on the rents if they're not able to fill these units. And I think multifamily, especially in markets that have tons of new construction, they're not going to be able to absorb it in time. Yes, over time, those units will get filled, but they're not going to be able to fill it up faster than their debt matures. So I just want to break that down because I think it's a really important point to understand that these investments themselves are not inherently bad or unprofitable. It is a combination of how much profit are they going to earn, and do they earn that prior to the time that they need to refinance? Because that is really a fundamental question. Yes, this is a good project. It was a great basis, and this is a great asset. But can you own it long enough, and can you own it and generate that income before your debt becomes due? That is the $64,000 question, my friends. And I'm thinking that here in these markets, they're not going to be able to hit that NOI, especially with these high interest rates. Industrial. Okay, this one is near and dear to my heart. I love industrial. If you follow this channel, I own it. I invest in it. Amazon is listing a tremendous percentage of its new warehouses for sublease. This includes their new construction projects and any of their leased premises. I just want to clarify that this is a little bit of a return to the median for Amazon, because during COVID and for the year after, they put their foot on the gas pedal. They were turbocharged and supercharged expanding. So after COVID cooled off and they didn't really have that same expansion rate, they have just reverted back to the median. Instead of being the number one consumer of industrial space, maybe they want to be number 5. However, they are continuing this downward trend, which is putting downward pressure on rents. To clarify, within industrial, this is not just the different locations, but it's a specific type of building. So if you're an investor and you're looking into industrial, do not be concerned even about Amazon putting their space for sublease. There is a very big difference from Amazon putting a 219,000 square foot warehouse in Fort Worth versus a 50 or a 20,000 square foot space. If you are looking at single tenant or multi-tenant or even smaller spaces, you could have a 10,000 square foot tenant. There is almost zero impact, even if you're trying to find those in-betweener tenants. Let's say there's a tenant that's looking for 150, but they're willing to sign 220. Those tenants are never going to impact a 50,000 square foot lease because that's not even on their radar. If they're looking for 150,000 square feet, I think the minimum that they could do is maybe 100,000 square feet, but it also has to be Class A, because if they're looking at this size of a footprint, they need 30-foot clear heights. They need 40 dock high doors. They need 100-foot truck courts. And so the tenants who don't have those strict requirements are not going to be impacted by a flood of capacity, because these landlords are not going to cut the price, and they're available for sublease. So Amazon is still paying the bills. We do think this is a little bit of concern, but development for all of these big box buildings, we call them bomber buildings because you could fit a B-52 in there, is stopped. It is almost completely dead in the water, and there is not really much concern about oversupply for the long term. Short term, yes, there's a lot of sublease, there's a lot of new delivery, but these are still getting leased. And so I think the key is that the industrial market is able to adapt. On the opposite side here, we have a 45-door truck terminal in Florida. It's fully leased, and it just traded hands for a very attractive price. So this is also that flip of industrial looks like it has sublease and it has some downward pressure. But if you have in-demand assets, if they are fully leased, you're able to move them and sell quite quickly. So Finally, this is a bonus tip, but anybody who knows me knows that I love cars. And so one of my favorite things is reviewing cars and bids, just kind of stalking these different auctions. But here was this 2012 Ferrari 458. It actually sold at auction for only $200,000. If you know anything about this particular car, that's a very low price. But I think that it's not really a sign of the recession. If we look in at some of these photos, yeah, nice custom plate there, Ferrari of Beverly Hills. This guy was running his Ferrari through a Brillo pad. I mean, the paint is in awful, terrible shape. It looks like a rental car that they washed with a mop in a dirty bucket. But look at this. Look at these swirl marks, and oh man, it's just horrible lines, scratches everywhere. This is not a deep, glossy, good condition paint job. Oh my gosh, look at this, guys. People just don't have money to maintain their Ferraris anymore. So maybe there is a recession coming. Let me show you also these interior photos, because there is one section, and I'm stealing this comment from Cars and Bids comments. It looks like they had a knife fight underneath the buttons. That reverse button's not doing so great. Somebody went to town with the butter knife trying to set the AC. All right, well, that wraps up this video. I hope that you learned something, and you really need to have a little bit of nuance, because commercial real estate is not something that can be analyzed altogether. It's not like the residential housing market. And again, we see a lot of analogies where residential housing, well, that's not the same if you're a tract home in Indianapolis, Indiana for $250,000 versus a $4 million house in Los Angeles. Those are two very different markets. And yes, interest rates do impact them to some degree, but thanks for watching. Have a great day, and we'll see you next time.